Okay, so I am here to focus on revaluation and the non-current asset. So we have our question here. So let's see, the firm is Cool, Cool. So this question is very similar to ACCA or any professional accountancy exam, right? So you will start by this is a full question, but this full question I decided to cut it and show the part that tells us or requires us to do non-current asset, that is tangible and intangible. But this is not a full question. I'm only doing the part that focuses on non-current assets, that is intangible and tangible non-current assets. So you will start our workings. Anytime you get a question like this, you start your workings from the note. So here you look at the note. Here we have note I, non-current asset, tangible. So cool, 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 right? So the note I says that non-current asset, which is tangible. So the leasehold property had a remaining life of 20 years. Leasehold property. So leasehold. So leasehold 20 years. 20 years remaining. Leasehold 20 years remaining. Now when you look at the question, when you go upwards, the question says that leasehold property at valuation as at 1st October 2007. Note I, it was 50,000. Here's it, $50,000. So leasehold property as at 1st October 2007. Now the question says that this trial balance relates to fate at 30th September 2008. So the trial balance is for 30th September 2008, but as at 1st October 2007, the cost of the leasehold property was $50,000. So the cost was $50,000. That is the cost. Now we are preparing our financial statement to 30th September 2008. That is the year end. And now the question is saying that it is having a remaining life of 20 years as at 1st October 2007. So what we need to do is to depreciate it to the 30th September 2008. So the company's policy is to revalue its property at each year end at 30th September 2008. It was valued at 43 million. Ignore the fair taxation on revaluation, right? So what we need to do is to depreciate it to 2008 before we revalue it. So we have to depreciate it. So equal to the $50,000 divided by the number of years remaining, which is 20 years. So the depreciation from 2007 to 2008 is 2,500. So now the carrying value is 50,000 minus the 2,500, which is equal to 47,500. 47,500. So the question is saying that The company's policy is to revalue its property at each year end. So as at the 2008, the carrying value was this 47,500. So in order to do your revaluation, this format is for every question on revaluation. So in order to do your revaluation, what you need first is your carrying value. What you need first is your carrying value as at the year or as at the time of revaluation. And now to get the carrying value, it is the cost minus the depreciation. So we subtracted this depreciation from the cost of $50,000 to get the carrying value of 47,500. That is the carrying value. Now in the middle, here is going to be a revaluation, either surplus or deficit. Right, depending on the figure we get. So if it is a negative, then it is a revaluation deficit, but if it is positive, it is a revaluation surplus. Right, okay. So after the revaluation surplus or deficit, looking at the question said that the company's policy is to revalue its property at each year end, and at 30th September 2008, that is the time that you are reporting, it was valued at 43 million. So we ignore the three zeros. So it was revalued to as at 2008, the year end. So revalued to revalued to 43,000. Right? Simple revaluation. You bring your carrying value, then in the second line is revaluation surplus or deficit. Then the third line is the amount that the company revalued the asset to. Now you find the difference. So the difference is going to give you or show whether it is a deficit or a surplus. Now the carrying value was 47,500 and it was revalued to 43,000. It was revalued to 43,000. So meaning that it was revalued downwards. So there's a deficit. So equal to the revalue amount less the carrying value. So we have a revaluation deficit of 4,500. That's all you need to know about the revaluation. That's all you need to know about revaluation. So first you bring your carrying value, then you bring revalue to, then the difference becomes your revaluation surplus or deficit. That's all. So we are done with the leasehold. Now continuing, the question said that on 1st October 2007, an item of plant was disposed of for $2.5 million cash. The proceeds have been treated as sales revenue by Faith. The plant is still included in the above trial balance figures at its cost of $8 million and accumulated depreciation of $4 million to date of disposal. All plant is depreciated at 20% per annum using the reducing balance method. Very simple. Now let's take it one by one. On 1st October 2007, an item of plant was disposed of for 2.5 million cash. The proceeds have been treated as sales revenue, which is wrong. The proceed is never a sales revenue because the company is not into selling or is not dealing in plant and machinery. So the plant is supposed to be a non-current asset. So when you sell the plant, the proceed is supposed to be a current asset, or so it is supposed to go to cash, not a sales revenue figure. So in setting up your workings, you say that subtract proceeds from revenue. So that's negative. It was 2.5 million, so 2,500. And since it was added to the revenue, meaning that it was not included in the current asset. So you add it, add proceeds to current assets, 2,500. So now we have our double entry. So that's all. So you add it to your current asset as the correct entry, then you subtract it from the revenue. Are you getting me? Now the question continues to say the proceeds have been treated as sales revenue by Faith. The plant is still included in the above trial balance figures at its cost of 8 million and accumulated depreciation of 4 million, which is wrong. On this 1st October, they sold it, but yet still it is included in the above trial balance at the cost of 8 million. Now, from the above trial balance, from TB, plant is equal to 76,600. 76,600. Okay. And now the question is saying that they disposed of a plant of 2.5 million, but it has still been included in the above trial balance at the cost of 8 million. So you subtract the cost of 8 million, which is 8 million, that's 8,000. So 8,000. So you add it, you get the final figure. So the carrying value after selling the plant is 68,600. Now we have from TB accumulated depreciation, we have the figure to be 24,600. And since it has been disposed of, the accumulated depreciation must also be taken off. So it was having an accumulated depreciation of 4 million to date. So subtract accumulated depreciation, which is supposed to be negative 4 million, 4,000. So you add it to get your final figure. So that's your accumulated depreciation and your carrying value. Now the question is saying that all plant is depreciated at 20% per annum using reducing balance. So if it was to say that it is depreciated using straight line, then you are just going to divide the cost by the number of years or multiply the cost by the rate or whatever. But since it is a reducing balance, you must know depreciation from financial accounting, but I have to go over so that you understand it well. Since it is a reducing balance, meaning that we apply the rate on the carrying value. So okay, this is the cost after the sale. Let me do it that way so that you understand well. And this is the corresponding accumulated depreciation. So now, if it was supposed to be straight line, you just divide the cost after the sale by the number of years remaining. But here it is reducing balance, meaning that we apply the rate on the carrying value of the asset. That's all what it is about. Reducing balance is applying the rate on the carrying value of the asset. So now, after the sale, we had the cost of the machine or the cost of the plant to be 68,600 and the accumulated depreciation to be 20,600, right? So now what we have to do is to just subtract our accumulated depreciation from the cost to get our carrying value of the asset. So after getting the carrying value of the asset, our depreciation is 20%. So depreciation the rate that's let's do the rate. So depreciation is now equal to the 48,000 multiplying the rate, which is 20,000. So the depreciation here is also 9,600. So this is the depreciation. This is the depreciation, 9,600. So we have a depreciation here of 2,500 for the revaluation, and we have a depreciation here of 9,600. Are you getting me? So now the carrying value of the plant that is supposed to be in the financial statement, the carrying value in FS financial statement is equal to this minus the depreciation. The carrying value in the financial statement is supposed to be 38,400. That's all. 38,400. Now we continue. The question says that depreciation and amortization of all non-current assets is charged to cost of sales. So we have our depreciation of 9,600. So it will go to straight to cost of sales. We also have a depreciation here. So this one also to cost of sales. So this is how you are supposed to set up your workings so you don't forget. So after doing your workings, you just scroll up. Okay, so this one is supposed to be in the financial statement. Okay, this one is cost of sales 9,600, because the question says that depreciation and amortization are all charged to cost of sales. So you add this to the cost of sales, you add this to the non-current asset figure, then the cost of sale for the revaluation, you add this depreciation, and this carrying value will be in the financial statement. And this revaluation surplus or deficit, it will always go to the other comprehensive income. Other comprehensive income, whether revaluation surplus or deficit, that is where it will go. So if it is a deficit, it will become a negative figure under the other comprehensive income. If it is a positive figure, it becomes a plus to the other comprehensive income. That's the only place that revaluation will go. It will always go to the other comprehensive income, and from there it will go to the statement of changes in equity. I will do a lecture on how to prepare the statement of changes in equity. So you are done with the note I, that's the non-current asset tangible. Now note II. Note II. Note II say, in addition to the capitalized development expenditure of 20 million, in addition to the capitalized, so this is the capitalized development expenditure as at 1st October 2007. As at 1st October 2007, that was the capitalized. So they say that in addition to the capitalized development expenditure of 20 million, further research and development costs were incurred on a new project which commenced on 1st October 2007. The research stage of the new project lasted until 31st December 2007 and incurred 1.4 million of cost. 1.4 million of cost. Very simple. So from October to December, so you are free to count your hand. So October, November, December, that's 3 months. So the question is saying that for that 3-month period, they incurred a cost of 1.4 million. That's the research stage of the new project lasted until 31st December 2007 and incurred 1.4 million of cost. So 3 months, there was a research. For that 3 months, there was a research of 1.4 million. So it is not going to be capitalized. This one, the basis from FA, you have to know. It is going to be expensed. So research, let's do it October to December. How much was it? 1.4 million. So 1,400. Now, from that date, the project incurred development cost of 800,000 per month. So from that date, meaning that the research lasted for 3 months, October to December. So from that date, meaning that from 1st January, from that date, the project incurred development cost of 800,000 per month. That doesn't mean that it should be capitalized. You have to know this. According to IAS, it is only going to be capitalized when management or it is certain that the development is or the project is going to be viable. From that date, you start capitalizing. So development cost of 800,000 per month from that date, meaning that from 1st January 2008, development costs were paid monthly of 800,000 per month. Now, on 1st April 2008, the directors became confident. So from 1st April 2008, that the directors became confident. From that date is when we capitalize. But from April backwards to January is going to be expensed. So we have another research expenditure. Another research from January. January to February. Mind you, it is from 1st April. So from January to February, we have another research which was $800,000 per month. So 800. So from 1st April 2008, that is when the directors became confident that the project will be successful and yield a profit worth in excess of its cost. The project is still in development at 30th September, and that is our year end. So now from April to September, and mind you, they are paying 800,000 per month. So from April to September, you capitalize. From April to September, you capitalize, right? So let's count our fingers from April to September. So April, May, June, July, August, September, meaning 6 months. So for the 6 months, it is going to be capitalized. So you capitalize $800,000. Number of months. The month was 6 months. So equal this multiplying the number of months, which is 6, which is 4,800, and here to the 800, that is January to February. So the 800 multiplying 2, which is 1,600. Okay, very good. Now what we would do next is that capitalized development expenditure is amortized at 20% per annum using the straight line method. Capitalized development expenditure is amortized using the straight line method. Okay, very simple. So how you go about it is that you multiply the rate by the 20,000 apples, that is capitalized. So okay, so let's add the capitalized one per TB, 20,000. So the total so now amortization is equal to this multiplying the rate 20%, 4960, 4960. That's all. So this is amortization. And now the question will say that all expense research and development is charged to cost of sales. All expense research and development. So these are the research and development which is supposed to be expense. So this will go to the cost of sales. And remember here today say that depreciation and amortization is charged to cost of sales. So our amortization too is here, which is 4,960. So all of this, so this is the cost of sales figure, cost of sales, the amortization and everything. So this is the cost of sales figure. That's the amortization and the expense research and development. So that's all you need to know about the non-current assets. That's revaluation and how to capitalize and whatever. Very simple. So subscribe to my channel for more accounting fundamentals or for more accounting videos. My next lecture I will be touching on goodwill. That's consolidated statement of financial position. I'll be touching on them. So do well to practice more questions as you sit for your examination. Okay, thank you.